Insurance bonds have been slowly re-emerging among financial planners as a way to supplement their retiree clients' incomes. And here today to discuss the strategies surrounding the investment product is Richard Atkinson from Austock Life. Welcome, Richard.
Thanks, Kristen.
So to start with, Richard, how do insurance bonds work exactly and what are their major benefits?
Well, insurance bonds have been around for some time in Australia and they have gone through various changes and iterations. The key thing about an insurance bond is it's actually a tax structure, and tax is paid internally inside the insurance bonds, similar to how superannuation works. So our headline tax rate is 30%, superannuation's 15%, but internally we pick up tax deductions as well. So you would see somewhere around 23–24% on some investment structures that you can choose. Now, the old insurance bonds generally only offered a capital guaranteed type investment structure, possibly a balance fund and so forth, but 2–3 options at the most. The modern insurance bond, like the one that we sell, is really a master trust of investments, so we've got currently 30 options on there. And you can invest in everything from cash, term deposits, all the way through to share funds and even a geared shared fund. So you have a whole range of investments in there, balance funds, etc. So we operate that way and offer the client good choice of investments. Now, the tax paid structure is also very good. Because what it means is we are the taxpayer, not the investors. So from an investor's point of view, there's no income to declare. There's no capital gains distributions to declare. There are certain rules. If you make withdrawals, then you have to declare some income, but there are offsets for that as well. So all in all, it's a pretty good structure from a tax point of view and from somebody who might be an income shy kind of client. And that could be for social security reasons, for retiree reasons, it could be for purely for tax reasons, or an offshore investor even.
Excellent. And so what are some of the strategies that Austock is encouraging advisors to implement over time? I've heard annuities are being used in conjunction with insurance bonds. How does that work? Yes,
look, I think current annuity rates are a bit discouraging. 2.5–3% is sort of some of the figures I've been quoted. You can certainly have a capital guaranteed income, and that's very comforting to some people from that point of view. However, if you're looking for a little bit more income, an insurance bond might be a better tool because you can change the investment mix. And if you compare it to, say, account-based pensions within superannuation, where you have a choice of investment, an annuity doesn't give you that. You simply get a fixed rate. So if you then take an insurance bond for non-superannuation money and set that up as an income stream, you can parallel your investment mix that you might have in your account-based pension, or put on top of an annuity which gives you the capital guaranteed comfort income stream, and then put some spice on top with maybe an insurance bond giving you an income stream from that. The great advantage of that income stream, of course, is you only declare the actual growth component of the amount you withdraw, so you have capital coming out alongside of that, which can be useful for reducing capital for the assets test, etc. Also, you do pick up the 30% tax offset. Now, if you don't utilise that fully against the income from the insurance bond, that offset can also reduce other taxable burden as well. So you can apply it to other income from other sources at the same time.
Okay, and you've mentioned a couple of times that not just non-retiree people, investors use this sort of strategy. How popular is it amongst non-retiree investors?
Well, look, it's I guess we like to think we're kind of responsible for the renaissance of insurance bonds. We started ours, I've been with the company nearly 11 years, and I guess I was the first marketer of the product. It's got a whole range of strategies that you can use. In fact, we have a list of over 55 things that people can use an insurance bond for. But basically, from a non-retiree point of view, a lot of people use them as savings plans for education funding. They use them for tax arbitrage. Any person or entity can own an insurance bond. We have a number of family trusts that own them. Family trusts particularly like them because they don't generate taxable income or capital gains distributions, which means the trust can quarantine income inside the trust without having to distribute it. And having beneficiaries to receive income from trusts is often a difficult thing. And so some trusts set up what we call bucket companies or corporate beneficiaries and put money into that, but at some stage the money has to come out of the company, and that can be taxable too if it's a dividend, and so forth, fully franked, no doubt. So using a bond in a trust is really good. It can quarantine the income there. As individuals, as I mentioned, education funding, but also people who do, are on top marginal tax rate, have money to invest. We also use them an awful lot in the estate planning world. And estate planning is something that a lot of financial planners are very cognizant of, and a good financial planner will always consider both the tax consequences and the estate planning consequences of any investment that they recommend. So using a bond can be very good. The advantages of that are that insurance bonds can be structured either as estate assets or as non-estate assets. And just like in superannuation, you can make a binding nomination. Difference being with a bond nomination, you don't have to renew it every 3 years. You can have multiple nominations, you can have partial nominations. And what that basically means is, because it's a life insurance product, although there's no risk component involved, A, it's tax-free on death, which is a great advantage. B, it will go to the person you nominate because it's a non-estate asset and cannot be challenged. So we're getting a lot of planners looking at these as an estate planning tool, and we have a lot of strategies based around estate planning.
Excellent. Beautiful. And is it just the one insurance bond that you offer, or do you have multiple sort of?
We only have one product. Ours is called, we call it an imputation bond, marketing name. But you do get the offset and you get the advantage of internal tax benefits as well. It combines the child builder bond, which is in legislative terms the old child advancement bond structure, which basically means somewhere between the ages of 10 and 25 you can nominate a child to receive the ownership of your bond. Until it vests, it's your bond, and if you die before it vests, it will continue on until it vests in the child's name. So that can in some ways mimic a testamentary trust. And we, again, this is estate planning. We do have a lot of people using bonds in that way. We even have some estates that have bought them. Because in the will it says, I want to leave little Johnny $50,000 when he's 24 years old. Most lawyers would tell you it's probably not worth setting up a testamentary trust for somewhere less than $400,000 or $500,000. So this can mimic that and do it quite easily, and there's no tax file number required, there's no tax reporting required, so set and forget as far as the trustee of the estate is concerned.
Excellent. Well, thank you so much for discussing the topic with me. It was really interesting.
That's good. You're welcome. Thank you, Christine.
Thanks.